I was examining the debt setup of the United States and noticed that back in 2009, virtually every entity, individuals, companies, governments worldwide, reset their interest rates to zero. It's as if there was a universal reset, and everyone has accumulated debts averaging around 3 to 5 times their income, continuously rolling over every 3.5 years. Curiosity led me to investigate the interest payments specifically made by the US, EU, Japan, and the UK, and what I uncovered was 3.5 years later, witnessing the significant surge in quantitative easing, I'm astounded by the constantly fluctuating and unpredictable economic terrain. In this ever-shifting landscape, comprehending the propelling factors becomes essential. Offering decades of expertise, Raoul Pal presents a unique viewpoint on the influence of demographic changes, mounting debt, and central bank strategies that are molding our financial trajectory. Pal underscores the profound repercussions of demographic shifts, especially the aging populace, and worldwide economic patterns. This transformation has led to a reshaping of decline in GDP growth, necessitating an increase in debt growth. The World Bank's 2023 International Debt Reports supports this observation, revealing that developing countries spent a record $43.20 billion amid surging global interest rates, underscoring the escalating burden of debt. Especially in poor nations, Pal delves into the role of central banks in influencing asset prices, particularly through quantitative easing. He argues that Q has fundamentally altered the landscape of asset at prices, creating a situation. Decades of experience in finance have given Raoul Pal a unique perspective on how demographic changes, debt accumulation, and central bank policies shape our financial future. Pal emphasizes the significant impact of demographic shifts, particularly an aging population, on global economic trends. This shift has led to a decline in GDP growth, necessitating an increase in debt growth. Reports from the World Bank in 2023 corroborate this, highlighting that developing countries spent a record $43.21 billion amid surging global interest rates, highlighting the escalating burden of debt, especially in poorer nations. Pal delves into the role of central banks in influencing asset prices, especially through quantitative easing. He argues that QE has fundamentally changed the landscape of asset prices, making traditional macroeconomic indicators less relevant. This perspective aligns with CNN's reporting, noting that quantitative tightening by major central banks is expected to withdraw $2 trillion in liquidity from the financial system over the next 2 years. The substantial fund withdrawal could profoundly impact global markets. In 2008, the global economy faced a significant crisis when governments worldwide reached approximately 100% of GDP in debt. This debt-to-GDP ratio posed challenges, as GDP growth couldn't sustainably support interest payments due to lower growth rates. This led to actions like cutting interest rates to zero globally and implementing quantitative easing. Quantitative easing didn't lead to the expected inflation in consumer goods, but did drive up asset prices due to the devaluation of currencies. Pal observed that this devaluation affected various assets differently. Using forward-looking indicators, Pal and his team forecast the growth of central bank balance sheets, linking them to asset price movements. Pal argues that everything in today's economy is tied to interest rate cycles and debasement of currency. Traditional metrics like value investing no longer work in the same way due to these shifts in economic dynamics. He notes that stock futures are positioned for a slightly higher opening, influenced by global events such as the Bank of Japan's policy announcement and critical U.S. inflation readings. He further suggests that the Federal Reserve's target might struggle to be met by year-end, with a possible need for policy adjustments to prevent real rates from rising. These insights point to a landscape where conventional economic rules are evolving, making it imperative to understand the complex interplay of factors influencing global finance.